Hey everyone, KYT here doing one last video before we call it a year. Thank you so much for the support. It's been crazy. The last two videos have been gaining a lot of momentum, getting a lot of subscribers. Again, thank you. I know a lot of you guys are fellow dads, and it's actually been a hard last month for me because my kid has been allergic, had a crazy allergic reaction. We think it's due to the antibiotics she was getting because she had pneumonia. So it's been a crazy week, but she is recovering. Now, I'm a believer in different investing styles and different investing approaches. People should do what they think works for them. Some people don't exactly have the time to manage their portfolio, or some are better being completely hands-off than making costly mistakes. And I do believe robo-advising is an approach that is good for some people. What's important for me is that people that want to explore different styles is that they get the opinion of different people on the different pros and cons of each style. In this video, we're going to define what I think my style is and why I think some of the concerns with this style are overstated, especially for those considering retirement and think passive income investing is a lot easier. I want to offer some counter arguments, and you can decide for yourself whether you agree or not. It's all good with me. Now, I call my style the global index investing style, and it doesn't really have to be, you don't have to be an XEQT to have a similar style. XEQT happens to have 4 different ETFs within it, and they each track a different index as I put them together here. But you're close to this style if you're mixing XEQT with different indexes, or if you have completely different set of indexes and you're trying to have exposure across the globe. You're a global index investor in my mind. On Morningstar, XEQT is seen as a blend ETF, a mix of different types of stocks, whether it's value, growth, dividend stocks. And I think that's important because a majority of people who are in XEQT or talk about this ETF think it's a growth ETF, and I don't think that's the right definition. I've been in discussions before where on Facebook where I've said, I don't really care for VDY. I'm an XEQT, and they're like, well, that's because you're a growth investor. And I don't think that's accurate to say that. That just because the dividend yield is low, that you're necessarily a growth investor, because growth stocks are defined in a specific way that goes beyond just whether it gives dividends or not. And these are the 3 main points I want to talk about. I want to talk about how our approach differs from dividend investing and why. And number 1, debate on diversification. Ben Felix is, of course, known for all these dividend irrelevance videos that have garnered a lot of attention. And I think the key message is very simple and is sometimes missed because I think a lot of dividend investors think their strategy is being attacked. But the key message is that if you're skewing your portfolio to have a high yield, you tend to have exposure to financials, utilities, consumer staples, energy stocks. And the argument is you don't want to have too much sector risk. So that's why the message is to not be too focused in dividend stocks so that you have exposure to many different sectors. Of course, the counter argument to that is a lot of investors that invest in dividends, I've talked to them, believe that their dividend stock portfolio is diverse enough for them. Like they think they have the right mix. And so this is like the simple disagreement. And we have seen in the past couple of decades, it really depends on the market crisis, whether a global equity ETF would get crushed more or a dividend focused portfolio, because we have seen some market conditions or some specific crisis where a dividend focused portfolio with specific stocks and like some sectors just survive certain crises better. So at the end of the day, sector risk for someone like me is a huge thing, and that's why I lean towards global diversification. And despite needing in retirement, despite needing to actively sell shares versus having those dividends be automatically given to you. Speaking of which, that's my second topic: concerns about selling shares and depleting assets. I think the number one reason I've seen a lot of people talk about the strategy where they're going to be growth until they retire, and then they'll switch to a dividend income investing strategy because they don't want to have to sell shares or deplete their assets. I've already done a video sort of covering this where the illusion of more shares in total return investing, where I talk about the fact that if you have the same amount of money invested and you have the same amount of total return, you expect the same total return, like let's say it could range from 4% to 12%, then the amount of money you have, the assets you have are going to be the same regardless of the number of shares. And I've even compared the easy example is when you compare two ETFs that track the same thing but have different share price values. So you'll have a lot more shares of SPDR or SPLG, than you would have SPY, which is a lot more expensive. But as long as their total return is the same, it doesn't matter that you have more shares. And I think the psychology is, oh, my stocks are going to rebound more because I have more shares. That doesn't actually make sense mathematically. And if we expect a positive return, doing this quick example, let's say 6%, this is why I show the gist of it is that the strategy that gives out less dividend, they compensate having less shares because their share price of each share is expected to be higher. So here we look at a portfolio that has $1 million where I withdraw $50,000 a year for the next 10 years, but I expect an annual return of 6%. So when you look at this, because 50,000 is less than 6% return, despite having less share as you go through the years, you start off with 40,000 shares, you end up with like only 26,000 shares you're selling, but because every share is a lot larger than when you started with, that's why your assets don't deplete and they might actually go up. And of course, the question becomes, well, KYT, this is like 6%, stable 6% as you go through the years. What about the negative years? The math stays the same. As long as the total return of both strategies is the same, you are not getting an advantage just because you get to keep your shares. Remember that the same amount of money, assuming the same total return is the same. That's the concept, but I do agree with the fact that people are more comfortable having the dividend being given to them rather than actively selling shares. I totally get that part of the argument, but I'm not depleting. I'm not going to deplete my assets faster than you just because you have a dividend income portfolio. So remember that. So I'll finish this section by looking quickly at this formula again. This is not debatable. This is how total return is defined. It's capital appreciation and dividend income. So if you have 12% dividend income and you don't expect depreciation in your portfolio value, then your total return is 12%, which is well above average, which is the reason why high yield funds tend to depreciate in their capital. Not because there's necessarily anything sketchy or there's a catch. It's just because there has to be, in this formula, for it to make sense. Unless expected total returns for the market is really high, then sure, you can have consistently dividend income and capital appreciation as well, but that would require the market doing really well. But in general, here, if let's say you expect, for example, like I mentioned, 6% total return, expected return, you would expect capital appreciation here to be minus 6%. So that's why having a dividend income strategy does not really necessarily guard you from depreciating that's a tongue twister, depreciating assets. Lastly, optionality. So one of the strong points for dividend income investing that investors tell me about is the fact that they can be active with what they can do with the dividends. They can spread the money across whatever investments they want. They like that optionality to be able to do that, to pay bills, whatever. They have money to be able to play with. And generally speaking, people that, of course, lean their portfolio, structure their portfolio to have more dividends or more income, most of the time, I would say generally they are active investors. Like you look here, this is like a video from Passive Income Investing. He's suggesting this portfolio for someone's first $1,000, and that's a ton of ETFs, right? That's completely different than the philosophy of our channel. Generally speaking, if you're going to tweak your portfolio to be more income, you're going to have to look at these different type of ETFs and put together a strategy that works for you, which is ironic and I feel is inconsistent when one of the main arguments I encounter is people saying, well, if you have a lesser yield portfolio. You're not going to know what to sell, when to sell. You might panic during a downturn, and it's better that those decisions are sort of handcuffed for you or decided for you. Yet they're okay with being active in a different way of choosing that portfolio setup, initial portfolio setup, of being able to decide what stocks to buy with their dividend income. So there's a level of optionality that they like, but then they look at like a lower yield portfolio and say, well, it's bad if you have the options to decide how much you want to sell based on, because the strategy of a lower yield portfolio, or what I'm going to do in retirement, is I'm going to adjust the amount that I sell of XEQT depending on how the market does. And I don't think that decision is necessarily something super complex. And if you're someone that is an active investor, right, this is where I think it's really ironic, like you should feel like you have the skills to do that, right? Like you're actively investing and making active decisions. And that's it for the video. I hope you guys enjoyed it. I don't really care which investing style you end up choosing as long as you're aware of the different pros and cons. And I did think global index investing had some cons that people mentioned that are way overstated. And with that, hope you have a great 2024, and I'll see you in the new year.